Thanks very much, Simon. Just want to check everyone can hear me. Apologies for my voice. I got the tail end of flu here. Fantastic. But yeah, I'm Keith McLachlan. We're going to have a look at what I call the SA Inc. thematic. Thematic investing has a place in the world. There's definitely tailwinds one wants to position themselves for. And I think South Africa, both from a South African perspective and actually from a global perspective, is something very much worth looking at and thinking about. So disclaimer, do work for an asset management group. We are invested in shares. There are multiple portfolios, multiple mandates, multiple clients. Talk about a company, assume I'm biased. It's always a good assumption. So agenda for the evening, so I'm going to introduce who and how, who we are, how we invest. Have a look at South Africa in the context. Context matters. We're in the relative world. Capital has to sit somewhere. History doesn't move in gaps. It moves in waves. And ultimately down to what next. And then I touch on what I believe are some current and real tailwinds while we wait for the much larger structural things to play out, which is the two-pot system and tourism. There's some other SA Inc. ideas, and then we're going to touch on summary conclusions and questions. So who we are, I'm not going to linger too much on this. We're part of a asset management company, asset management group, Rockwood, Element Investment Managers, Integral. Importantly, though, our philosophy in the listed space is that we have a quality bias. We like good companies over bad companies. And when picking those good companies, we prefer to not overpay for them. So we are value conscious. In this, we put them together and we build things called building blocks: domestic equity, global equity, commodities, fixed income, local, offshore, etc., etc. And those building blocks then ultimately get scrutinized, and fund managers and portfolio managers and the like can execute it at individual client level, individual mandate level, depending on what is appropriate. But all of this comes through, and we're managing onshore unit trust, offshore unit trust, segregated portfolios, PSPs, AMCs, etc., private clients, wealth managers. We even serve you coffee if you turn up. South Africa. So here's the reason you're here. Let's touch on the context. And the context is very important. Here is South Africa before the recent elections. Last set of elections was 2019. You could see on the right here, you can see the outcome. ANC dominated. It arrived. Well, it maintained the government that we've had largely since 1994, but I would argue since the Zuma years, and hence it reinforced the trajectory you see on the left. For the last decade and a half, the Rand has been steadily weakening. Offshore markets have been outperforming local markets, and sovereign bond yields, i.e. interest rates, have been rising, but particularly in the sovereign space, i.e. South African government debt. That just indicates rising risk. You've got to be paid to take that risk. That's what the before the election picture looks like. Now watch the right very, very carefully. Jumped forward to there. What you'll see is the color changes quite nicely. Far more balanced outcome in an election. We've arrived at the government of national unity. No worries, I can carry on talking. We arrived at the government of national unity. And what does that really mean? Well, it means something very, very different. And you can see in the graphs on the left, and that star is when the election happened. At that point on the top, the Rand starts strengthening. At that point in the middle, the local markets start outperforming the global markets. And at that point in the bond market, sovereign bond yields, i.e. sovereign risk, starts to fall. Now the market is pricing in a good outcome here. And to be honest, this was a better outcome than we thought was plausible in terms of scenario planner. Well, not plausible, that's the wrong word, and likely, but this was the best outcome, and the market's pricing it in. Does that mean you rush out, buy SA Inc., everything and moves, gobble it up? Well, the challenge is it's always easier to destroy than it is to build/rebuild. So the rebuild is much slower. And the above chart is the consumer confidence. In fact, business confidence came out today. This is the challenge of building these presentations in advance, is that data, in fact, comes out on the day. And you'll see when we touch on Southern Sun, their results are out today. So already the stuff in this pack is somewhat dated. But what you can see is that there has been an improvement on consumer sentiment, but it remains negative. So we're off the bottoms. Same with business confidence that came out today. It has had, I think it is a number of quarters of positive revision upwards, but remains below 50, which is still below. The long-term running average, if you have a 10-year rolling average of business confidence, is 43, which is interesting. So 45 is above that. The point being is, although the trajectory of South Africa has changed, and hopefully for the better, and long may it remain, the fundamentals still remain fragile. The consumer still is under pressure. And I love this quote from famous brands in their latest set of results that summarizes it. The green shoots of confidence are yet to result in economic growth, and the positive sentiment has not materialized in terms of spending this reporting period. My feeling is we probably have another 6 to 12 months of pressure as we come out of this hole. So just going out and blindly buying SA Inc. may not be the greatest strategy, even though if you zoom out, it is looking good and the market is pricing in positives. So what do? Well, you want to invest in facts. One of the facts is two-part. I'm not going to go into the two-part system. I suspect everyone is tired of it, everyone has heard of it, everyone's been preached it, but for maybe like the 3 people on this call or in the room who don't know, who are too embarrassed to say, it really gives you a savings pot in your pension fund that you can access. It came into effect September this year. It is retrospective with a nice little lump sum, and then going forward, your savings are split into a savings pot and a pension pot. Now, what does that really mean? Well, there's been a whole lot of captive savings sitting at asset managers that has been unlocked that can flow into the real economy. And how much? Once again, it's amazing how quickly data gets dated. But at the point when I was building this, SARS had announced that 21.4 billion had been reported so far since the two-part system got initiated in September in terms of withdrawals. Simon, correct me if I'm wrong, but your MoneyWeb now show yesterday morning, the number was up to 35, I think it was, yeah. Now, there is a debt component of it and a service component and the like, but these numbers are working on a net after-tax basis of 21 billion that's flown in. You can just gross the numbers up and flex it. The point is how it trickles down. And it's also important that what follows now is not forecasts, it's maths. There's a big difference. But this money of savings gets redeemed and it flows out. Where is it going? Why are people accessing these things? Well, and I quite enjoyed this, touching on Simon's radio show. In that on X, formerly known as Twitter, the poll, Simon, that you ran was, what are you accessing your two-part savings for? And number 1 was paying debt, which lines up with this graph I'll talk about for a moment. But then there was general spending and education. 16% is spending it on holidays. Guys, if you're accessing your pension savings and spending it on holidays, please talk to your financial consultant. If you don't have one, let me know. I'll get one to call you. That is not what you should be doing. But decisions like that aside, Discovery has an exit poll that they published. Once again, it's probably dated, but these sort of statistics, I don't think anyone has a reason to lie on them. Why are you accessing your savings? Well, you could say anything, you're still going to get your savings, so why not just tell the truth? So I think it's probably quite an accurate representation. And 2/3 of the savings are into home and car expenses, short-term debt, or education. Well, what is that? Home and car expenses is cost of living. So that'll flow through retailers and grocery and car dealerships, perhaps, probably not, but mostly like the ShopRites, the Pick and Pays, and the like. And we'll chat about for a moment why that's not important. Short-term debt is repaying debt in education of schools and varsities. Now, those are two ones I want to zoom into, but I want to touch on why home and car expenses I don't think is as important as everyone thinks it is. So the argument there is we must all hold retailers because they're going to get the spending from two-pot system. 21 billion was drawn out of it. You know what ShopRite's turnover is in a year? 240 billion. If ShopRite got 100% of that, it will only add 8% to their turnover. And they won't get 100% of it, they'll get a proportional representation. Mr. Price published their results today. The reason it rallied despite missing earnings expectation is because they touched on that what their sales had done in September, and their sales was up 12%. You work out the delta on that, my guesstimate is they got about 200 million rands worth of two-pot savings spending. That's sitting in that line item. That's a nice little one-off for them. That's fantastic, but it's not going to change the business case dramatically. So I'm going to zoom into short-term debt and education. Because what is short-term debt? Well, you go, Keith, the argument for repaying debt really is banks, and banks are even bigger than the retailers, so that doesn't move the dial on them at all. Except, and you're right in the banks, but don't forget, debt has debt collectors. And in South Africa, the largest debt collector is actually listed. And everyone forgets that it's currently called Transaction Capital, is about to be called Nutun Limited, because everyone focused on We Buy Cars and SA Taxi. So before we get into the debt collection part of it, let's address the elephant in the room in terms of Transaction Capital. Is it sustainable? What does the group look like? Well, after unbundling We Buy Cars, the group that had a large amount of debt had net cash. They realized capital on the unbundling. They had net cash of 120 million, so no debt. Then they sold NCH, then they sold their Australian operation, and all in all, after transaction fees and costs and maybe an investment bank or two's lunch, they have about $1 billion of cash. So the balance sheet is fine. What's going on with SA Taxi? Who cares? Let's assume it's worth zero. They have done a deal where they're halving off the equity, they're getting a strategic partner. Let's assume it's worth this. If it's worth anything, that's a bonus. So that's what I want to touch on in terms of transaction capital. Now I want to zoom into Nutun. Nutun is South Africa's largest debt collector. They collect debts in two ways: by agent. In other words, you're a Truworths or Foschini's, or a bank or XYZ, and you've been selling stuff on credit and you can't collect from these guys, so you put the book up for auction. These guys buy the book cents in the rand, and then they use their own debt collectors to go and collect on that book, and everything they collect above what they paid for that book, and they really do pay cents in the rand because this is bad debt, is all just profit for them, and those books can actually last surprising numbers of years. They currently have 7.9 billion rands of debt that they have claimed to, not on their balance sheet, they have claimed to. They paid cents in the rand for it. Now, if you look at what the business looks like, CX, which is 49% of revenue, as you can see up here, CX is really offshore BPO. That's the part that excites everyone, and correctly so. If you have spoken to any landlords in Cape Town, you'll know that every spare space is being rented out by call center agents. South Africa is exploding in terms of BPOs and call centers, but that's not the side that does the debt collecting. the side that does the debt collecting is CE. Let's just call it debt collection. And that's 51% of the group. So let's do a little bit of math. 51% of the group generated, where was it? 770 million rands in 6 months. That's rounded up to 1.4 billion rands across a year. Is that a lot or a little? Well, 21 billion of two-pot capital is flowing. If we then take it and we figure out, because you go back to here, and 21% of it is going to pay back short-term debt. 21 billion of, 21% of 21 billion is 4.5 billion. 4.5 billion is a fair chunk of money when your turnover is only 1.4. Now, how much are you going to get? Anyone's guess. This is not a forecast. Once again, this is just math. But it's important to appreciate the way debt collection works and the way call centers work is if you suddenly collect more debt, your costs don't change. Your costs are pretty fixed. So it's a good assumption that this windfall, and some of it should flow to them, either via the book that they own or via the other books that they're working on behalf of other people. Remember, as a principal or as an agent. If just 4.5% of the 4.5 billion that is going to pay down debt flows to them, their profits jump by 50%. So there's a lot of delta in the bottom line that can happen here. First thing. The next thing is, how much are we paying for that? Well, ignoring the two-pot potential windfalls. If you have a look at its peers globally trade at 16 times multiple. Nutun, ignoring the two-pot windfalls, has a run rate of about 300 million a year. Taking out net cash from its market cap, we're paying about 4 times multiple for it. Its peers trade at 16. Let me phrase it this way. Nutun, well, Transaction Capital and what will soon be called Nutun Limited, can double its valuation and still be at a 50% discount to its global peers. And then you add on the BPO growth wins globally, and you add on the debt collection windfall from the two-pot system, and you start to get a really, really attractive story. So that's debt collection. The next really interesting windfall is in the education space. Now, 20-odd% of two-pot funds are flowing into the education space. That breaks of 21 billion, that breaks down to 4.3 billion that flows into this space. Is it going to flow into the public sector, or is it going to flow into the private sector? By virtue of the public sector, it's much less cheap. My argument is the vast majority of that's going to flow into the private sector. And of that private sector, it's going to appear in 2 different ways. It's going to appear in, there might be some more fees. So some students turn up at school that wouldn't have turned up before, but perhaps more subtly, it's going to turn up in fees being paid that would have been bad debts. Both of those things are relevant because both of those things drop to a school or a university's bottom line. Now, in the private sector, the education space, we happen to have 3 stocks listed: Curro, Stadio, and ADvTech. I can go into the differences in the business models, but this is a purely mathematical exercise to show, once again, the delta that these companies can have on their bottom lines. Now, by my calculations, those 3 are 10% of the private educational space. So if 10% of 4.3 billion flows to them, and we assume no one wins market share, no one loses market share. And once again, I'm not assuming it flows into the top line, or I'm just assuming it flows into the bottom line because it can also turn up in less bad debts. That also counts. We can calculate effectively the additions, the two-pot boost to revenues, well, to bottom line. Perhaps I should have rephrased that. And you can see how it jumps up. Now, this is where it's relevant. How does that compare with the existing bottom line? And particularly in Curro's case, where they're almost 5 billion 12 months trading revenue generated only 55 million rands of profit, a 144 boost to their bottom line significantly changes the picture. And you can see that in the top chart, where the EV EBITDA, once again, this is a mathematical exercise, not a forecast, so it's just taking their current, so it's almost like a pro forma exercise. Take their current earnings, add that in and see what it looks like. It drops by a third. But Stadio, ADvTech, both of them benefit in the teens as well. So this space definitely benefits. Curro proportionally a lot more than the others, but once again, it's far more meaningful impact to these smaller businesses that are getting larger allocations as opposed to ShopRite or Pepcore that have such vast turnovers. So in summary, one could play the two-part system via retailers and banks, and you'll probably get somewhat of a positive benefit. But because of the base effect, it's much diluted. Significant amounts, though, are flowing to debt repayments and education, and of that, the largest debt collector is listed in the market. It's Nutun, and we've got 10%, about 10% of the private education sector listed, that for the last couple of years have been struggling with bad debts. Hopefully won't have them now, being Curro, ADvTech, and Stadio. So two-part systems, quite real. The money is flowing. We don't know how much, but it's certainly a large chunk of money that flows into the economy, that if you can find the right positions, there are companies and business models that are beneficiaries of this. The next thing that is quite real is the e-visa regimes. So as a tourist, when you travel, you don't want it to be complicated to enter a country, and you don't want it to be difficult to leave. You want as frictionless travel as possible. And South Africa for a long time has a very cumbersome visa regime, which they're cleaning up, and they're in fact adding a remote working visa. And importantly, two countries, India and China, they've always struggled with visas for various reasons. I think in China's case, there was only 1 or 2 places you could go and it had to be in person and this and that. Now they can do e-visa. It can be all done online. There is no reason this cannot and should not benefit our local tourist industry significantly. So what do the numbers look like? Well, pre-pandemic, we are running at about somewhere between 1 to 1.5 million tourists a year. And by the way, when I'm talking about this, I'm talking about inbound foreign tourists. We're not talking domestic tourism. Visa doesn't matter. Visas don't matter for domestic tourists. Inbound foreign tourists. If you have a look at what that generated, it seems to be about 120 billion. With, for example, that hotel market running at about a 60–70% capacity. The bottom chart comes from Southern Sun. It's a show of the occupancies and room sold, and you can see it trickles along there. Now, that goes back to pre-pandemic. That includes the messy, cumbersome visa regime. Where we are today is we haven't fully recovered to pre-pandemic, and that's what the chart to the top right shows. We still are slightly lower in terms of inbound tourists. So one, there is just mean reversion where we just get to pre-pandemic levels. There is upside in this industry. But two, why shouldn't we surpass that, and quite significantly, with positive visa regime, lowering the frictional costs and boosting the appeal of staying in South Africa? Well, maybe you don't want to travel to South Africa for crime. That is a relevant argument, and it's bit beyond this conversation. That one must be taken up with the police. But you certainly are not traveling. You certainly are not deciding not to travel to South Africa based on economics or commercial. If you have a look at Southern Sun's ARR, and this, by the way, comes from an Alan Gray research, article that they put out. So kudos to them. I thought it was really, really good. And Southern Sun's average room rate, that's what ARR stands, is roughly half of not the global average, of comparable nations like ours. Half. In other words, this 121 billion that we generated, we could double it and we'd just be pricing in line with peers. But so there's all of this attractiveness of this industry, where one, we are still recovering after COVID. Two, in fact, we're in a better position than pre-COVID. And three, we're deeply underpricing ourselves. So as that capacity gets filled, the pricing will lift up. So it's a double leverage effect. It's not just more volumes, but at better pricing. So, and I'll touch on some of the other aspects that play this market, but I think the best one that stands out to me is Southern Sun. It was unbundled out of Tsogo Gaming, which is now Tsogo Sun, and it seems they change its name every 5 minutes. But Southern Sun, if you have a look at it, ignoring my argument for tourism, just have a look at it before the pandemic, where it had an occupancy of 59%. It was earning HEPS of 26 and a net debt of 3.3 versus in 2024, right? Well, like I said, it actually technically reported results 2 days, so this is slightly out of date, but the previous one, where at a slightly lower occupancy, it's earning double the profits and it's paid off 2/3 of its debt without issuing a share, unlike City Lodge. There is no dilution that happened in this company. They just ran it really, really, really well. And it is actually a better run company now because of COVID. It forced them to relook at their cost base and how they operated. So they're a better company than before COVID. And yet you look at its valuations, EV/EBITDA, which is the enterprise value divided by EBITDA, is kind of like a debt neutral price earnings. And given that debt has moved such a lot, EV/EBITDA is quite an important measure because price earnings will distort things. EV/EBITDA pre-COVID was 13 times. Today it's only 5. And actually following this morning, I think 5 is actually too high. It's dropped with these latest set of results. One can also take the enterprise value divided by the number of rooms they have and arrive at how much am I paying for EV per room. Now the problem with that is rooms are built, but building inflation happens in the background. They don't revalue their rooms. So I've gone back to just before COVID, valued the EV to rooms, and applied inflation to bring it into terms today, not real, but nominal terms today. And in fact, EV to room was 700,000 per room. You'd be paying 760 now. So very, very marginal difference. And yet you have a look at the spread of their rooms. The one that worries me on this slide is Mozambique, but that's a discussion for another time. But 2/3 of the rooms, Western Cape, KZN, Gauteng, exactly where you want to be in South Africa, especially Cape Town is flying, but there's a lot of delta, a lot of uplift that can happen in KZN and Gauteng as well. So exactly where you want to be. So what does this look, this positive e-visa regime, what does it look like for Southern Sun? Well, and when I was building this math, my view is they can reach an occupancy of 70 to 75%. With their results this morning, they had occupancy of 58%, slightly up from 57. But that doesn't tell the full picture because that's an average for the period. So if you look H1 to H1 last year, that's occupancy is up. Then in just H1, you look at Q1 versus Q2, it's up to 62% in Q2. And in Q2, you just look at September. September, it was 68%. It might actually hit my 70 to 75% occupancy a lot sooner than I expected. But once you start to hit that, going from this 57% to 70% adds 2 to 3 billion to their revenue, assuming no pricing difference. They haven't priced their rooms differently, but in reality they do. As they fill up, they ratchet up the price. But let's just keep this simple because that's hard to quantify. What does 2 to 3 billion do? Well, it adds 30 to 50% to revenues. 20% of running a hotel is a variable cost, so 80% of it drops to the bottom line. That doubles their profits. Now, once again, not a forecast, but a glide path using basic math and these tailwinds to help. I'm going to zoom through this quickly because why don't we play it through Southern Sun, Sun International and Sogo Sun? Well, both of them are predominantly gaming operations with casinos, and casinos are predominantly local consumer discretionary spend. You don't fly to South Africa to gamble at our casinos. That's not really why you're here. Why don't you play it through City Lodge? City Lodge is more business travel aligned. That's more local GDP. If our GDP picks up over the next couple of years, that should do a lot. That should start to do better than Southern Sun. Not that much impacted necessarily by visa regime. There may be a spillover effect, but hard to compare them versus history because they had a, I believe the term was massively dilutive rights issue. Absolutely. So difficult to compare, whereas I can measure Southern Sun back to back because they didn't issue a single share over that period. So in summary, improving the visa regime boosts tourism in South Africa. It just quite simply does. We're not even back at pre-COVID levels, but these changes arguably make us a better destination at half the price of any other place. Why shouldn't we actually surpass pre-COVID levels? No one's built big new hotels, well, not really, other than the Marriott down the road in South Africa, so that there's not a surplus of capacity. If we suddenly get back to more normal levels, we just start to reprice, and it all falls to the bottom line for these hotel operators that are well positioned. The best beneficiary of that, in my opinion, is Southern Sun. So a couple other SA Inc. ideas. I'm going to run through this relatively quickly, and then that's open for questions. One of the things, and these are slightly longer term, is a GNU government hopefully rebuild South Africa. That needs building materials, that needs construction. The construction companies, one could play it through, you know, Steph Stocks or WBHO. Maybe those are valid ways. Their average through the cycle operating margin is 2%. That's painfully small. You get one contract wrong there, that whole year is a wipeout, no matter how good it is. So I prefer not to play in that space. I'd rather play it through building materials. And everyone looks at Afrimat and goes, that's an iron ore company. Well, it's got iron ore and it's got a couple other things like coal in it, but the core part of the business is quarries and aggregates, building materials. And in fact, they just bought Lafarge that they're turning around. In fact, although it still created a loss in a later set of results, the last month or two was profitable. So they're getting it right. And they're going to be a major cement player locally. And all of this rebuilding uses cement, uses aggregates. And these guys are good operators at good margins. Don't forget, Lafarge has a significant multi-billion rand loss, a tax loss as well. So you're not going to be paying tax for a while in that part. Quite like Afrimat, but that might be a slower burn because building things is really, really hard as opposed to standing up and talking. Netcare is another one. Some of the aspects of a positive South Africa may not be doing things, it may be stopping bad things happening. Not saying NHR is good or bad, but in its current envisioned structure, it's definitely depressed the pricing in our local healthcare stocks. The most direct, the clearest, and the neatest and cleanest play, and funny enough, also the cheapest, is Netcare. So if NHR is either revisioned or blocked, expect the hospital sector and Netcare to bounce and might re-rate higher. Or one can actually just ignore everything I've said for the last 35 minutes and just buy a basket of shares. So I run the AMC with the code UUSMC. It only holds South African small and mid caps. Some of these names up there you'll recognize. Some of the other ones I haven't touched on, but you can see it's all very, very good, solid South African beneficiaries. So in summary, South Africa, the macro is turning, but it hasn't turned. It's a long, hard road up. It is always harder to build or rebuild than it is to destroy things. But there are some near-term tailwinds. And two-pot is that, particularly in debt, for debt collectors. And the biggest one in South Africa is listed inside transaction capital and soon to be only transaction capital, or Nutun. And then in the educational stocks, Curro, Stadio, and ADvTech. Tourist tailwinds, don't discount that. We offer a really good destination, particularly arguably Cape Town, Western Cape, but the whole of South Africa, really good destination, really cheap. We're lowering the frictional barriers to come in and enjoy our country. Why shouldn't we get our fair share of global tourism? Particularly if we manage to navigate the global geopolitical space as the Switzerland of Africa, relatively neutrally. Why couldn't we get both East and West visiting here? Those are very positive, and Southern Sun, in my opinion, but arguably a couple others stand to benefit. And then there are some other players, Afrimat, Netcare, and SMC, that one could play as basket plays or specific longer term views. So I spent a fair amount of talking. There was quite a bit of maths. I only saw one or two of you guys fall asleep. That's all right. I count that as a win. So shall we have some questions?
Now that it's doubled the price.
I thought it was expensive at half its current price. But the market clearly said I was wrong. So
the fun fact, G20 in Joburg next year in November. Sandton is fully booked for 3 weeks, and Rosebank 98% booked for 3 weeks.
So the Cape Town Convention Centre is Southern Sun in their presentation today. The Cape Town Convention Centre is fully booked through the whole of next year. If you wanted to, you can book it. And I hope I'm not misquoting on that, but I'm pretty sure Marcel said that. So great question. First of all, I think Southern Sun is only a premium hotel if you're South African. Remember, it's charging half of what its peers in other equivalent countries to South Africa is charging per room. So even if you're Indian or Chinese, you look at this and you go, that's actually not a bad price. That's probably, and if you have enough money to buy the flight, enough money to go and travel globally, you probably have enough money to pay for that room, and you go, gosh, South Africa's really, really cheap. So that's the first thing to think about. Second thing is the hotels do use booking.com. It's not competing, it's just another distribution channel. So I don't see that as a problem. Airbnb is an interesting one. I think you will absolutely get some spillover into Airbnb, and there will be a beneficiary of it. But the experience of booking in a person's house relative to a hotel are quite different ones. So, I mean, I know I actually prefer not to Airbnb. I prefer to stay at hotels. Like, you know, you can just come and go, and it doesn't have to be awkward conversations about keys and endless rules and funny things. And yeah, so people have different experiences. I think there's a place in this world for both. And I think both will absorb that. Understand that these numbers and everything I said are happening with Airbnb operating in Cape Town and Joburg and everything. So, and Southern Sun in September at a 68% occupancy. So absolutely, summer's going there. I don't think it's changing much. It's a big industry, and if you ramp the numbers up, everyone can feed off it.
Interestingly, Parliament has promised to table a legislation around Airbnb or short-term rentals. I don't know if they will. I don't know what it will look like, but that could be quite a caveat as well.
Yeah. So there's
a similar question to Simon. So if you look at Afrimat, is it cheap or expensive? And I mean, it's had a long run. And so in looking at the EV to EBITDA, is that screaming cheap?
So
fair,
with,
or are you only looking at fundamentals?
So it becomes a complex one to unpack the valuation, because if you're valuing a mining company, and let's be honest, a quarry is just a low-grade mine. You're a finite resource. So therefore, you want to DCF it, discounted free cash flow, for the life of the resource, because at the end of it, you stop generating revenue. And therefore, looking at it from a multiple basis is the wrong way to look at it. But Afrimat then has Lafarge, and they have the building material side, and that has other assets in and things like that. And then you're getting a spectacular management team, which how much do you value them for? That is the only actual mid-tier miner in South Africa, and therefore can cherry pick exactly what acquisitions they want. They are too small for the majors, but are too big for the small guys. And if you're in that playing field, there's only one door you knock on if you're selling an asset, and that's Afrimat's. So when you put all of these things together and you unpack them, our analyst, a guy called Bruce Williamson, believes that there's value in this. That's the long way of unpacking it with a very short answer. Well, the Comcom blocked that, and unless they can appeal it, which I'm not hugely intimately familiar with that process, but they can.
They can appeal, but
Has anyone ever won an appeal?
No, like not once.
Because you're kind of ruling on your own ruling. You go, no, I was definitely right.
So the way the competition thingy works is there's three different parts to it. They're kind of like siblings. And if the one says no, you go to the other sibling to appeal. And when I say like no one's ever won an appeal, I mean, probably there has been one or two, but not to my memory. You just don't win appeals.
So the short answer, and I actually think Pete Fillion said it very nicely. He's got a weekly newsletter, and by the way, it's worth subscribing to. He writes wonderfully, and he actually wrote about it today. And the point about casino licenses is that they don't overlap each other. So their argument that this creates concentration in the industry means either one, you don't understand what you're ruling on, or two, you've issued too many casino licenses and there are overlaps. It doesn't matter, it is a ruling. Comcom is what it is. I think it's detrimental. It would have been a great acquisition. Piermont currently has too much debt. It's being badly run. Southern Sun would have de-geared it, run it better, and reinvested. Casinos are capex heavy investments. What I mean by that is, have you ever walked into a casino where it was in really bad nick, like not painted correctly and really dingy and seedy and horrible? You don't really want to go to that casino. So you've got to keep spending to make your casinos look good to get people into them. Piermont hasn't.
Wait for the crackdown on online gambling.
Yeah,
the numbers on online gambling are terrifying. Yeah. Who was it? I forget now. The majority of card transactions are going to online gambling, Sunbet and the like. The government's going to crack on that hard.
Yeah. So
they should, in my view.
Yeah. So I think they've done a great job turning Sun International around. It did involve a significant rights issue. I mean, give me a couple billion rand, I'm sure I could turn things around. But that is a bit of a blow to them. That would have been a great acquisition. Yeah, sorry, I'm not sure if that fully answers your question. Yeah.
Cool. So when you talk about the two positions, isn't the major withdrawals are finished? The next one, next year.
Remember, it keeps getting topped up.
Yeah, but next year, people who bought cars paid off major debts. It's going to go down quite a bit, I guess.
Yes. So some of these are one-off. Some of these are continuing. It depends which way you view it. I think a system that has more liquidity in it is better than a system that has less liquidity in it. Makes sense.
But also how it worked. Remember, you could only withdraw 30,000 as of 1 September, which means that's so going forward, as of 1 September, you can take a third of contributions. So if you've contributed 100,000 over the course of the year, you can take a third out. So there's going to be a continual bit of rolling. There's obviously a lot of het up that comes initially, and then eventually it will tail off. Absolutely, it will. But this is something which is now just sort of going to be built into the system to a degree. A lot of folks are like, getting out of debt, fixing personal balance sheets. But for a lot of folks, it's pretty much every year or so. If you're putting in, I don't know, what's the maximum, 350 a year. Let's say you're putting 300K a year into your Reg 28. You can now take 100 out every year between now and retirement.
Yeah, Simon actually answered that more clearly. I was a bit esoteric about liquidity, but that's what I mean, because you're filling up this pot the whole time, and it can be accessed. Now, like I said, We got to talk about the 16% that we're spending on holidays. you need a podcast just about that.
I'm a fan of holidays, man. I always support
mental health spend.
What we don't know is how much is this kind of like, I don't know, getting your hand in the cookie jar and now you've got a sore tummy and you don't go draw more. We don't know what the longer term will be. It's a really much better system because in the olden days you could access it. What you had to do was basically resign, cash in, pay and save tax. This was a much better system. And just a quick point, when they talk about the 2 parts and 1/3 being the savings part, it's not actually then invested as we would think savings. When we think savings, we think cash and near cash. That's not the case. It's been invested into equities and the like, but it is just technically savings rather than low risk.
Because I would like to ask as well on the 2-part system, if this creates some sort of like long-term wind at the back with the 2-part withdrawals becoming like some sort of annual bonuses for people to go on.
Unfortunately, I think some people view it that way, which is not, once again, those people should talk to a financial advisor, but it is what it is. I think perhaps the more subtle benefit is it does give people a exit hatch if they get into a jam in their life. You know, they get into debt, and one can get into debt through bad luck as well. You know, perhaps the house wasn't properly insured and burns down, or this, or bad examples, but you see what I mean. And instead of going bankrupt with pension savings you can never touch on, you have to quit your job to access, and it becomes a disaster. You go, you know what, I need a little bit of liquidity right now. I'll access that, and that doesn't become bad debt. That then flows into the system. So we actually, by improving the liquidity of the pension system, we're lowering the systemic risk, and that comes through in lots of very subtle ways. One hopes most people are responsible, and I think most people will be. There's always fringes, but I think there will be a continuing benefit. It will be interesting to look at, like, decade or two before and a decade or two after in terms of bad debt ratios, NPLs, and things that all the nice, pretty bad debt stuff that the banks publish. There might be a change to it.
Also, I mean, it's a 35 billion, and Lex, I mean, the estimates are anywhere between 60, 80, 100 in total. It's a big money for us, right? You give me 100 billion, you never see me again. Promise. If you want me to disappear like an irritating,
So that's your price. I could, half that, guys, half that.
But in terms of the whole pension part, I mean, it's big, but it's not the end of the world. I think it's a great system. It's going to be abused. So you know what?
Let me phrase it this way: the PSC alone manages over R1 trillion. It's up to 2 trillion. Yeah.
Sorry, my second question. In terms of just, I'm talking about South Africa, and I think South Africa is quite driven partly by the Chinese economy and how they do it. They get a
or how they don't do, which is more current.
And given their valuations, compared to market valuations like the US, etc., their tech versus our tech, the US tech, etc. And also, the GNU and how they're performing. I mean, foreign institutions are buying debt and bonds, but they're not buying equity. It's taking time for them to, get into the whole South African growth story. But if the South African economy does well, don't you think the banks, the mining companies, are sectors that you should look at? I mean, you have tourism, debt collection, but what about banks and mining entities, PGMs, etc.? Are they not?
So mining companies are more global plays. Let me phrase it this way: don't ask the question where the operations are. Ask the question where the customers are. Where's Anglo's and Billiton's customers? They're in China mostly. That's who consumes their commodities. Those aren't South African plays. Those are export plays into foreign markets. You need China's property market to be booming, etc., and things like that. Who knows? Maybe Trump rebuilds America and they become a big customer. It's not really South Africa that uses those. Even if we were to be growing at 5% a year, which we're not, and none of the indications are we're close to that. Although, shush, that would be amazing to see again. Even if we were, the vast majority of the big mines outputs would still be exported, would not be consumed by us. So no, I don't think the mines are a good way to play this. They're influenced by sovereign risk. What I mean by that is if you've got a mine in South Africa and our mining legislation gets better, our infrastructure gets better, etc., well, that's a better mine than if it were in a country that has worse infrastructure, worse legislation, etc. So those things come through in terms of more stable production, lower costs, etc. But it's not a South African play then. The mines and commodities are global plays. Banks, yes. It's the sheer size and scale of them that makes the base effect challenging, but they kind of track the sovereign rating as well. And I think the one thing that's throttled our banks is a bank in a sovereignty, being South Africa, cannot be at a credit rating better than the country who manages their license. And I actually think our banks are better quality than our country. So as an S&P raised our outlook the other day, if you see our sovereign rating rising, our banks will naturally get upgraded with it, and that's a positive thing. Bad debts, lending into infrastructure booms and everything, definitely banks would benefit. Once again, it's a question about delta, i.e. what's the effect on the bottom line, and what might move Standard Bank's results by 10% would move transaction capitals by 1,000. So which side of the delta do you want to be on? But those are perfectly valid ways. I just wouldn't consider the mines a South African play.
I've forgotten our banks are junk.
Yeah.
Makes perfect sense.
But they're not actually junk, but those are the rules.
Have you tried that? No,
We are in Standard Bank, we want to get out. So one of the reasons I found the local gaming plays challenging is because what drives gaming revenues at its very core, consumer disposable income, and that's still under pressure in South Africa. And we didn't get a 50 basis cut today, we got a 25 basis cut. Municipal rates and taxes are still running at triple inflation. There's still challenges. It's likely 6 to 18 months before the policy changes and the improvements the GNU's made will trickle down into the real economy and lift up growth rates, and disposable income will lift. And therefore, the consumer might still be under pressure. There, arguably, absolutely, some people might go and gamble. I mean, if you're going to spend your two-pot savings traveling around, maybe you're going to gamble on it too. There might be some that flows through there. That's even more terrifying. But you see my argument is we're trying to look just very directly at what's moving things now. And one can always shift 6 months, 12 months, 18 months and go, you know what? Consumer disposable income is growing. South Africa's hitting 3-4% growth. Let's start buying consumer disposable income players, of which casinos, gaming, discretionary retailers, these are all exactly what those are. But where we're sitting at right now, those are going to be challenging numbers coming out.
Just to make sure we just talked about now, what policies has the GNU implemented that's going to change the economy? I don't see anything happening.
Well, notice the lights are on. So first of all, it's more, there's different parts to this question. First of all, it's what didn't happen. That's also very important. Notice we had a peaceful election, a change of power, second time in our country's history. We're a democracy, and sovereign risk dropped dramatically. And you could see that in the bond yields. You just needed no event for that to prove. And that's a good thing. We're a democracy, we can cast our votes, political parties listen, and they get together and they figure it out. The second thing is there is now competition in government. Notice how many ministers are now tweeting, and they're trying to do things, and they're trying to ask, because they've got 5 years, it is about 5 years, eh? I always forget the election cycles. Yeah, they've got 5 years to prove that their party did better than all the other parties, so that they win more votes next time. You've actually got competition in the public sector now. And then there's things like the e-visa regime, that's wonderful. That's absolutely, I mean, it's such an easy win. Is foreign tourists that want to come see our beautiful country, make it easy for them to come and see it. Gosh, what an easy win. There's big problems, water, big problems, Gauteng, Joburg. I mean, we're a big part of the GDP up here, and the guys on this part of is not functioning. So what I'm saying is things aren't perfect, but you can see that the trajectory has changed.
And it's to your point, I mean, not much has happened. The SABC bill got pulled. It was a bad bill. But we've got Scopa, who've now got proper people in charge there. And the real test is going to be, I think, next year. What bills get brought to Parliament, what gets voted on, etc., etc. I think Keith's point is that we changed governments. And let's be clear, when America tried to do that in 2020, it didn't go so well. We had a peaceful transition.
Yeah,
and
it really was.
And it's a horrible thing to say, but the world looks at us as Africa and thinks Mozambique or Zimbabwe. No, that's what they do. I mean, let's be perfectly clear. They're wrong, and us as Africans know this for a fact, but the world doesn't. And I think the world looked at this and were like, yo, look what happened. Botswana as well. Yep. Namibia next month. The world was, like, frankly, probably surprised, and it'll take some time. And then next year is going to be the proof.
Yeah. But like I said, it's always harder to build than destroy. In the last decade and a half of nothing, well, that's been easy. You just did nothing and everything crumbled. Now you actually have to go and figure out how to fix it and do it. It's going to be slower. It's going to be harder. It's going to be messier. It's not a linear, it's not a straight up curve, but the initial movements have been positive.
Don't underestimate the effect of electricity. Yeah. I mean, on our emotional psyche. But I mean, the Reserve Bank said that they thought it was taking 1.5% of GDP.
So
and that's now just back on the table.
So talking about Southern Sun, in their results today, the last period that had load shedding, it cost them 23 million rands of diesel. The latest period, having the lights on, cost them 19 million with electricity hikes. So you go, oh, there's only a 2 million rand difference. That's marginal. Who cares? The difference is significant because you're not turning hotels on and off the whole time. Their maintenance costs drop dramatically. It's not the power that's the problem. It's the interruptions that are the problem. You can solve power, generators, solar panels, etc., etc. It's the interruptions in supply chain that's the problem. But yeah, these are all positives. Doesn't mean it can't be derailed. Doesn't also mean that just like tomorrow we are 5% growth economy. It's going to be a long, hard, slow slog, but the trajectory has changed. It's not going down, it's starting to go up.
Folks, I'm going to leave it there because we've hit time. Appreciate all of your time coming through this evening. And it's wild. We have, so no one believes me when I say like everyone arrives. Like we had 32 people booked and we had 32 people arrive. Typically people expected 32 booked, maybe 6, but it's a wild stars. We're back on the 11th of December. As always, appreciate, look after yourself if you can, somebody else as well. Keith, boys, thank you very much.
Thanks very much, guys.